as stocks continue to rise. We talked about this. The S&P is just like 17 points off a record high right now. And my next guest says the underlying trend remains positive for equities, including for the large caps, which she likes here. Kate Moore is CIO at Citi Wealth. Kate, anything about the Fed here affect your view on stocks? Look, weak dollar has certainly got to be a boost, although maybe it's not about the Fed, as Mohammed just said.
Yeah, well, look, I think the equity market is looking past anything regarding tariffs, is not really focused at all, frankly, on what may be this softening. We can debate if it should be softening or weakening trend in terms of the overall economy, and is really asking itself, are there parts of the market, especially largest market cap companies, that will have sustainable earnings through all parts of the cycle? The answer is yes, across the AI and tech space. Will marginally lower rates be supportive for risk? They're answering yes. I'm worried, though, that the market is a little too complacent. I think from technical reasons, and at least my read on sentiment from a wide swath of different investors, is that people want to buy the market a little bit here. But I worry that we're a little bit complacent and that there are risks and challenges to risk assets in the second half of the year, even if there is potential for the market to end the year higher from here.
So you think, all right, let's talk then about whether this is a market that, people are chasing Art K and it's getting way ahead of themselves and it's divorced from reality, or is it based on reality?
There's a little bit of both. And so let me just maybe clarify my comments. What is based in reality actually is the strong, sustainable earnings trend, the very solid balance sheets, the free cash flow profile of many of the largest companies in, say, the S&P 500. So people are comfortable owning them for the medium term, even if there's some rockiness or slowdown in the economic environment. On the other hand, there's a lot of other stuff that's a little bit weaker, and it's a reason why in our portfolios we've continued to favor large cap over small and mid cap, which I think even in an environment where the Fed cuts twice in 2025, the growth trajectory that we were on pre-tariff announcements would suggest a more challenging environment for these companies. And we know that they are located in different parts of the supply chain. They tend to have less pricing power. They're less geographically diverse. They're more dependent on bank lending than long-term funding at the large cap. So there are lots of reasons. So I'd say there's a mix on fundamentals. Within the large cap space, we are getting positive news out of those leaders taking the indices higher. Yeah. But in the small and mid cap side, which we've seen all these tactical trades, as you're very aware of, I see the fundamentals deteriorating.
Yeah, no,